Under the periodic inventory system, the inventory general ledger account is not adjusted as every transaction occurs. Instead, we wait till the end, and at the end of a financial period, we go out and we take do an accounting of what our balance is. Once we know what the balance is, then we adjust all our inventory accounts accordingly. There are some important inventory relationships that exist, and you really must memorize these. They come up multiple times in your classes, and that also will come up again when you take the CPA exam. Beginning inventory is what you start with. You add to that anything you have purchased during the time period. This includes the costs of, say, freight. This includes your purchases and purchases adjustments. When you have a periodic system, the purchases, again, don't show up as debits to inventory. They show up as debit to purchase accounts. This becomes then goods available. This is the only amount you can possibly sell. This is the cost of all that you could possibly sell in a time period. Those costs can either stay with you in ending inventory, or they can be sold in the products you sell. If they're sold in the products you sell, we call this cost of goods sold, and we show it on our income statement. If it's in the ending inventory, it becomes the part of the balance sheet, or it becomes the total of the inventory account, which shows up in your balance sheet. First thing you need to do with this adjusting entry is to remove the balance in your inventory account. So you will credit for your initial balance. If you're working in the SUA packet, you will look at the inventory account, and you can see that we haven't done any journal entries that affect that account. So really you're going back to the beginning balance and you're removing that balance. The second thing you need to do is look at your purchase accounts and remove all those balances. So your purchase accounts that have debit balances, you will want to credit them. And the purchase accounts that have credit balance, you will want to debit. This removes the balance in the inventory. It removes the balances in your purchase accounts. Then you want to establish a new ending inventory number. That will be your debit. So you will debit for the new inventory number. The difference should be such that you will need a debit to make your journal entry work, and that debit should be your new cost of goods sold. So this journal entry, this adjusting journal entry, which I have over here in this red box or maroon box, will remove the beginning inventory with a credit. It will take all your purchase accounts which have debit balances, and you will be crediting them, and purchase accounts that have credit balance you will be debiting. The purchase accounts need to also include freight in. So freight in will show up as a debit. You will need to credit it. So it will be included here. It will be credited. Now, cost of goods sold will be a debit, because that's the way it's going to show up on the financial statement. And if you were to look at your account called cost of goods sold, you will see that it is zeroed out. It has no balance. You are establishing a cost of goods sold for this time period, and you're doing it when you do this journal entry. It is a plug number, I say, because after you've completed this, and this, you will have a remainder which you need to make your journal entry work. That is a plug number, and that number right there is cost of goods sold.